Today we will understand corporate actions and its impact on stock prices. The company pays dividends to its shareholders. Dividends are paid to distribute the profits made by the company during the year. Dividends are paid on a per share basis.
It is not mandatory to pay out dividends every year.
If the company feels that instead of paying dividends to shareholders, they are better off utilizing the same cash to fund a new project for a better future, they can do so. Besides, the dividends need not be paid from the profits alone. If the company has made a loss during the year, but it does hold a healthy cash reserve, then the company can still pay dividends from its cash reserves. Sometimes distributing the dividends may be the best way forward for the company. When the company's growth opportunities have exhausted, and the company holds excess cash, it would make sense for the company to reward its shareholders, thereby repaying the trust the shareholders hold in the company. The decision to pay a dividend is taken in the annual general meeting during which the directors of the company meet. The dividends are not paid right after the announcement. This is because the shares are traded throughout the year, and it would be difficult to identify who gets the dividend and who doesn't. Dividend timeline. Dividend declaration date. This is the date on which the AGM takes place, and the company's board approves the dividend issue. Ex-dividend date. The ex-dividend date is normally set 2 business days before the record date.
Only shareholders who own the shares before the ex-dividend date are entitled to the dividend.
Record date. This is when the company decides to review the shareholders' register to list down all the eligible shareholders for the dividend. Dividend payout date. This is when the dividends are paid out to shareholders listed in the register of the company. A bonus issue is a stock dividend allotted by the company to reward the shareholders. The bonus shares are issued out of the reserves of the company. These are free shares that the shareholders receive against shares that they currently hold. There is a bonus announcement date, ex-bonus date, and record date similar to the dividend issue. Companies issue bonus shares to encourage retail participation, especially when the company's price per share is very high. And it becomes tough for new investors to buy shares. By issuing bonus shares, the number of outstanding shares increases. But each share's value reduces. The face value remains unchanged. What this means is quite obvious: the stocks that you hold actually are split. When the company declares a stock split, the number of shares held increases, but the investment value, market capitalization remains similar to the bonus issue. The stock is split concerning the face value. Suppose the stock's face value is rupees 0.10, and there is a 1:2 stock split, then the face value will change to rupees 0.5.
If you own 1 share before the split, you would now own 2 shares after the split.
Like a bonus issue, a stock split is usually to encourage more retail participation by reducing the value per share. The idea behind a rights issue is to raise fresh capital. However, instead of going public, the company approaches its existing shareholders. Think about the rights issue as a second IPO and a select group of people. The rights issue could be an indication of promising new development in the company. The shareholders can subscribe to the rights issue in the proportion of their shareholding. Needless to say, the new shares under the rights issue will be issued at a lower price than what prevails in the markets. However, a word of caution: the investor should not be swayed by the company's discount, but they should look beyond that. A rights issue is different from a bonus issue, as one is paying money to acquire shares. Hence, the shareholder should subscribe only if he or she is completely convinced about the company's future. If the market price is below the subscription price, right issue price, it is obviously cheaper to buy it from the open market. A buyback can be seen as a company's method to invest in itself by buying shares from other investors in the market. Buybacks reduce the number of shares outstanding in the market. However, buyback of shares is an important corporate restructuring method. There could be many reasons why corporates choose to buy back shares. When a company announces a buyback, it signals the company's confidence about itself. Hence, this is usually positive for the share price.